factory activity in China improved slightly in August, although still in contraction. Government data showing that the Manufacturing Purchasing Managers Index came in at 49.7 in August. That's up from 49.3. The index was below the 50 mark, which is the cutoff for growth. Non-manufacturing PMI, which covers construction and services, showed a slight growth reading of 51. Now, new rules from the Netherlands that will restrict exports of advanced chip-making tools start Friday. They were first announced in June. The Netherlands will join the US and Japan, who have similar controls. The Dutch regulations do not mention a specific country, but they did draw a comment from China's Commerce Ministry.
The Chinese government is maintaining communication and exchanges with relevant countries in the field of export control. China hopes that all parties, including the Netherlands, will uphold an objective and fair stance and market principles, abide by the spirit of the contract and international rules, maintain a free and open international trade order, and protect the legitimate rights and interests of enterprises.
Separately, Chinese property developer Country Garden is issuing more than $34 million worth of new shares to pay debt. According to a statement by the Hong Kong Exchange, Country Garden will not get any of the cash. The shares will be used to offset a 2021 loan from Kingboard Holdings, a Hong Kong manufacturer. This is Country Garden's latest effort to pay off its loans. Now, separately, Moody's recently downgraded Country Garden's credit rating again to a level that indicates the firm is likely in or very near default. Property, semis, chips, factory activity. We're going to figure out what this all means for the economy there. Jeff Moon joins us. He's the president of China Moon Strategies. Good to see you again. So let me start, because there's a lot to go through. Let me just start with what we talked about with the property market, because a lot of people are saying that the government needs to do more. It's no secret the property prices have not gone in the right direction. People's equity have not gone in the right direction, and there's a lot of not just political issues, but there's real economic issues in paying off a big mortgage, which anybody who's lived through the last 20 years can appreciate. What's happening in China, and why can't it be fixed?
Well, the real estate market really has structural, systemic, and long-term problems. I've seen that there is enough housing stock to last 7 years in China, which means that there's just a vast oversupply. And it's going to take years for this to work out. I really think that the government needs to prepare the public for a difficult time ahead. We've seen these kinds of real estate problems in other countries. Here in the United States, 2007 to 2008, in Japan in the early 90s. Those were public and very painful episodes. The effects are still lingering on, and I think China has a lot of work to do in order to work out.
One thing they have going for them is the sheer number in terms of population. Now, Europe went through this, sort of speak, in 2008. We went through it during the similar time period, and time does heal things, right? Because interest rates there are not the same as interest rates here. So as you're building more equity into place, albeit maybe the price of the home doesn't necessarily go up, but at least you are building some equity. Could that be a positive?
That is a positive, and the government is trying to cut interest rates, but there are also signs of deflation. And when you have deflation, people wait before they purchase because they think that the price is going to be lower if they wait until longer. Then there's also the temptation for stimulus within the economy. But you really need to be careful about stimulus because that just inflates the asset bubbles that are already out there. It limits consumption and it prevents that money from being used for more productive purposes. So it's very tricky. It's a tightrope that the Chinese government's going to have to walk.
I had a couple of recent calls with experts in the field like yourself, and they keep using the B word, which is the bazooka. They want Beijing to have this giant bazooka to stimulate the economy. And they kept asking me, well, why can't they do that? You know, other countries have done it in the past, and I gave my reasons. But it does perplex me that what a lot of people, at least the international community, expects them to do versus what Beijing is comfortable doing. They have cut rates. They've done some parts to stimulate. And some would say it's not enough. And I'm curious from your point of view, one, is it enough? Two, if not, what needs to be done?
Well, the temptation to use big stimulus would feel good in the short term. And that may be why investors want that kind of stimulus. I think the Chinese government has wisely signaled that it may stimulate a little bit, but that large stimulus is not going to be forthcoming because, as I said, it will just inflate asset bubbles. I think that the market is going to have to work through this bubble in the real estate economy. And you have two examples of how to do that from history. You have the example of Japan, where the bubble was basically covered over and not dealt with and lingered for 2 decades. Or you have the United States, where the bubble popped tragically for many people. I mean, maybe China can find some approach that's between those two that does deal with the problem, but deals with it in a way where the landing is a little bit softer.
Help us understand the way China sets interest rates, because a lot of people are talking about it's also an FX story as well. You don't want to have excessive money flows in either direction. And by the way, there's still a big export question mark, between the U.S. dollar and the RMB, and you don't want to disrupt that either.
Right. Well, the interesting situation is that cutting interest rates really doesn't make that much difference in China, I don't think, because interest rates are already extremely low. And China hasn't had the kind of inflation that we've had in the United States, where interest rates needed to be raised to tame that problem. So I'm not so sure that interest rates are going to solve the problem. A lot of the steps that the Chinese government is taking to deal with the problem and stimulate consumption are good, solid steps, but none of them are the silver bullet that's going to solve the problem.
What does China look like, say, December, January, February coming up? Are things going to get better, or are we going to be in this sort of stalemate where we continue to ask for stimulus and experts say, well, you're just going to have to be patient?
There are a variety of factors. Real estate, of course, is one big factor, and I think that the real estate problem is going to linger. And that there will not be massive stimulus because, as I said, that's a short-term fix that wouldn't solve things in the long term. There are other aspects of the economy, though, that need to be dealt with. China needs to increase consumption to make the transition from its investment-led economy. And that's a story that needs to be told. Foreign investment is also a part of that story. And as the visit of Commerce Secretary Raimondo highlighted, there's a real problem with foreign investor confidence. And I think that the Chinese government is aware of that problem. I'm not sure they're adopting effective measures, but that's something that could also help the economy. So there are lots of variables. It's not just about real estate, but real estate being a third of the economy is the biggest of the problems.
Yeah, well, I think we all have some ideas on how to fix the confidence issue. We'll save that for another time. Jeff, good to see you. Thank you for your analysis.
Thank you.